Welcome to Sarah and Ronald Presents Fun with Flex.
If you're buying a HDB, one of the first big questions is, should I take a HDB loan or a bank loan? Let's break it down so you can decide confidently. So both have pros and cons, and the right choice really depends on your budget, your risk appetite, and your long-term plans.
First, for HDB loans. So the interest rate for HDB loans is currently fixed at 2.6%, and this is actually 0.1% higher than the CPF OA rate. So it's 2.5% plus 0.1%, giving us the 2.6% for HDB loan interest rate. So when using HDB loan for your down payment, you are actually required to utilize almost all of the CPF OA funds that are available, with only the option of keeping up to 20,000 per buyer. So then what are the requirements for HDB loan? So the most important is not to have your monthly earnings exceeding the income ceiling required and stated by HDB. So for singles will be 7,000, couples will be 14,000, and extended families at 21,000. So then what are some of the drawbacks when taking up HDB loans? So HDB loan at 2.6% interest rate can potentially be higher than bank loans currently in the market. However, one of the bonus of taking up a HDB loan is you can do multiple partial repayments throughout the tenure that will not incur any additional costs. What about bank loans? So for bank loans, the interest rates are actually volatile and pegged to market conditions. However, it can be lower than the 2.6% of what the HDB interest rates are. One possible consideration is during your purchase, the upfront down payment has to be the first 5% in cash only. So then what are some of the advantages? So first, you have the flexibility to utilize more CPF funds or cash to lower down the eventual mortgage financing. Second, you can save more in the long run if interest rates remain low. So third, you can actually get the lock-in periods with the banks depending on their different packages. Lastly, you are able to reprice with the same banks or even refinance to other banks if they have more attractive packages. So then what are some of the disadvantages? Firstly, it's subjected to the approval process of the banks. Second, bank interest rates are volatile and pegged to market conditions. Third, there will be possible penalty if you do sell your property within the lock-in period.
Rule of thumb, if you value stability and lower cash upfront, then a HDB loan might be better. But if you're comfortable taking some risk and potentially save on interest, then a bank loan could work as well. Also, did you know that even if you choose a HDB loan first, it is still possible for you to refinance to a bank loan after that. Choosing the right loan could potentially save you thousands in the long run. If you want us to help you calculate which option works best for your budget and goals, just drop us a message. I'm Sarah.
And I'm Ronald,
your property partners. Let's help you make smart moves in the property market.